Hello friends, welcome you all to the Economics of Finance Excellency batch. I'm your friend CA Saurav Jindal from KSJ Teaching, and we are going to get excellency in this particular subject, and you people are surely going to clear this particular subject, right? And along with this Economics of Finance, all of you know that we have the financial management course also in English, in Hindi, both are available. And the English version is available on our mobile app KSJ Teaching. You can download it. All the links are given in the description of this video. And if you like it, please hit the like button and subscribe to the channel. Press the bell icon, because on the daily basis you must get the reminders that yes, the lectures are being uploaded. You have to watch it. Okay. So now what we have been doing is we are done with our first chapter, that is the national income accounting, and moving on to the chapter number 2, that is Keynesian theory of national income. Again, a very important chapter. I hope whatever we have studied so far, that is about the national income accounting, you people have revised it, you people have done it thoroughly, that how to calculate the national income, what are the various ways in which we are calculating, various methods that we have discussed. Now what happened, sir, this Mr. Keynes, he gave some theories of national income. Theories of national income means that how to determine the national income, what are the various elements that are involved in the national income, what is consumption, what are the various behaviors that help us in determining the national income, right? That is the theory. So the theories tell us that how we are determining the national income, what are the various behaviors, what are the various factors which are contributing in the national income. So all these various theories were given by Mr. Keynes. So let's read it out. Please keep your books with you, because everything we are going to do it from the book itself, right? And all those who have not yet ordered, because some of you might be watching it for the first time, if you want to order the handbooks of this Economics of Finance, you can order it from a website, that is ksjteaching.org, and very simplified language. You will get examples with the topics, and you will be able to remember the topics for a longer period of time, right? Because from the ICAI module you can do it, no, absolutely no issues to me, right? But the difficulty part is that there it is given in the paragraph form, and I have broken that into the various pointer forms so that it is easy for you people to comprehend and remember the language. Okay, so let's do it. Introduction. The Keynesian theory of national income determination was given by the British economist J.M. Keynes in his book, The General Theory of Employment, Interest and Money. So this was the book in which he has given the various theories of national income. This theory was presented through three different models. So basically he presented the three different models and tried to explain the national income using these three different models. The first model is a two-sector model, that is where there are only two sectors in an economy. One is the household, another sector is the business sector. Then comes the three-sector model, where the household is there, business sector is there, and additionally the government sector is there. Then comes the four-sector model, where household is there, business is there, government is there, and the foreign involvement is there, right? Exports and imports are there. So we are going to discuss, this whole chapter revolves around these models, right? The whole chapter revolves around these models, that what is a two-sector economy, what is a two-sector model, what are the various components, what we need to study in that two-sector model. Then what is a three-sector model, what is a four-sector model. Very simple, right? Very basic, and related to our day-to-day activities. You only need to be very attentive while listening to all the things. That is why I say these books are important, because when everything, the content is written in front of you, you just need the attention. Okay, so let's start with the first topic that we are going to start with is the circular flow of income in the two-sector model. Circular flow of income we have already studied about, right? That manufacturing of goods, the payment of factors of production, then the factors of production spend that income, right, on the on buying the goods, and then the goods again are manufactured. So this circle keeps on moving. Now he says how it will move in a two-sector model. First of all, tell me, is that really possible? Is that really possible that there is an economy where there is only a businessman and a household? Household means you, me, which are not doing business, which are not, we are not manufacturing some goods. We are the consumers of the goods, right? And there is no government. Can there be any such economy, sir? If there is any such economy, then that's wonderful, isn't it? No government intervention, no tension, no taxes, nothing at all. Just relax it. right? Just a relaxed environment where the business is manufacturing the goods, you are consuming the goods, having the fun, that's it, right? So is that kind of an economy really possible in the real world? Do you think it is really possible? No, sir. So that means when we are talking about this two sector model, sir, this is a very hypothetical model. Very hypothetical model. That is the first thing that is written. It is a hypothetical two sector economy. That is, it does not exist in reality, because in reality the governments will always be there. How can you run an economy without a government? Who will take the decisions? Who will set the budgets? Who will take all the other matters? So it is not possible. That is why I say the two sector economy is quite an hypothetical economy. In this, there exist only two sectors, namely the household and the business sector, right? Now, who are the households? What do you mean by the households here, and what do you mean by the business sector here? Sir, the households are those people who are the factors of production, who are providing their services in the manufacturing of goods. You, me, we are the consumers of the goods. We are the household sector. And what is a business sector? Business sector is the one which is involved in the manufacturing of goods or the provision of services, right? So this model assumes that there exists a closed economy, that is no foreign sector, no government intervention, there are no taxes, right? So it is kind of a closed economy. It is like a room where only one businessman is there and a household is there. Nobody is allowed to enter. No foreign sector is allowed to enter. No government intervention is there. No taxes are there. But this kind of an economy does not exist in reality. Okay, the households own all the factors of production and provide their factor services to the businesses to earn the factor income. Now try to understand. Now try to understand this two sector model. Two sector model. Right? Just try to understand. Right? Keep your books with you. Nothing to write if you are having the books. Nothing to write as such. Right? Everything is written in the book. I just want some explanation to be given. After that, we will read it from the book. Right? This two sector model. Now, what is he saying in the two sector model? He says there are only two people. One is the household sector. Right? And the another segment that is available is the business sector. Right, sir? Another segment is the business firms. Okay. Now, what are the households? The households are all those people like you, me, and we are providing our services in the forms of factors of production to the business firms, right? So what is this household doing basically? This household is providing the factor services, right? This household is providing the factor services. Now, what will business do? Providing the factor services, right? Now, for these services, are they going to provide these services free of cost? As an individual, if you are providing some services, let's say you are a chartered accountant, right? You are a chartered accountant, you are providing your services to the business firm, which is definitely indirectly helping them in the manufacturing process, right? So you are a chartered accountant, you are providing the factor services to the business firm. Now, will you do it free of cost? Yes, sir, we are definitely going to do it free of cost because you are teaching us free of cost. So definitely we are also going to provide all our services free of cost. Please don't do that, right? Please don't do that. Okay, now what will happen? If you're not going to do it free of cost, then what will happen, sir? Business firms will pay to the households, which is what known as the business firms will pay them, which is known as factor income. Factor income from the viewpoint of households. From the viewpoint of business firms, it will be a factor cost, right? Right, sir. Now what will happen? Now, using the factor services, what will happen? The business firms will manufacture goods, isn't it? Business firms will manufacture goods, and the business firms, what will happen, sir? Will manufacture goods, then they are going to sell those goods, right? To whom they are going to sell those goods? Business firms are going to manufacture and sell those goods. Manufacture and sell goods. Manufacture and sell goods to whom? Household, because that is what we studied in the concept of circular flow of income that, sir, as soon as the households receive the factor income, they will be spending that factor income on what? On the buying of goods and services. So that means in the manufacture and sell the goods, that means the households are going to pay for goods and services, right? The households will pay, the business will manufacture the goods and sell it to the household. The household will pay for that goods to the business firm, with which the business firms will manufacture more goods and services. So this is how in a two-sector model the circular flow will go on, right? Let's see. Now the households are providing the factor services to the business firms, right? And the business firms with those factor services are going to produce the goods and services, as well as for the factor services, the firms are going to pay the factor income to the households. Now, with the factor income, the households are going to do the expenditure part on the buying of goods and services from the firm. And with this, our circular flow of income will continue to happen. Clear? So this is a very simple, straightforward two-sector model where are only two sectors, that is the household and the firms. Let's read it from the book now. We say that factor income so earned is spent on buying all the final goods and services produced by the business firm. There is no savings on the part of household. He says whatever the income the household is receiving, right? Let's say you are a worker, you provided your services to a firm, right? And you got 5,000 rupees. That is what the example says, that Ram provided the factor services to ABC Limited. Now Ram is what? Ram is a household, right? So what is Ram? Ram is a household, and this ABC Limited, this is a business firm, right? So two sectors, one is household, another one is business firm. The Ram is a household. The Ram provided services to ABC Limited and earns rupees 5,000 as factor income. He has provided the factor services, and for those services he is getting the factor income of 5,000 rupees. Absolutely correct. Now he says he spends this whole 5,000 in buying the various goods by business firms. Now whatever he is earning, if he is earning 5,000 rupees, he is spending the whole of that 5,000 rupees, he is not saving anything. That is one of the major assumptions of this two-sector model, right? Business firms hire the factors of production from the households to manufacture the goods or for providing the services, as we have already discussed. The manufactured goods are then sold. Manufactured goods are then sold to whom? They are sold to the households only, right? Income earned by the business firm from the selling of goods and services is spent in the form of factor payments to the households, and there are no corporate savings. Even the household is not saving anything, right? Whatever the household is, business firm is not saving anything. Whatever the business firm is earning, by selling the goods and services, let's say this business firm earns 1 lakh rupees from the sale of the goods and services to household. Now this 1 lakh rupees is used in the payment of what? In the payment of factor income. This is what they are saying, that they are not doing any corporate savings. There are no corporate savings. Whatever they earn, they spend on the factors of production, right? For example, ABC Limited manufactures and sell goods worth rupees 5,000. This 5,000 is then paid to Ram, who provided his services as the factors of production. Continuing with that example only, we say that ABC Limited has sold the goods and they earned 5,000 rupees. Now this 5,000 is the salary of Ram for providing the factor services. So 5,000 is paid to Ram, and the Ram again will spend 5,000, which will go to the firms. The firms will again manufacture the goods, pay 5,000 to their worker, and the circle goes on, right? So they have mentioned Y is equal to YD, where Y is the total income and YD is the disposable personal income. Have we discussed about it? Sir, Y is the total income, whatever is the total income, but what is the disposable income? The disposable income is actual income which is there in the hands of an individual or the household, which he or she can spend actually on the buying of goods and services, right? So we have already discussed about the disposable income, that personal income, disposable personal income, that personal income minus the taxes, minus any other statutory requirements or the dues, right? After paying all those things, what is actually left in the pocket which that person can spend on the buying of goods and services, that is a disposable personal income. That is why I told you that you must revise first chapter. Must revise first chapter before this one. Very, very important. Okay. So this model shows the real flows and the money flows. What is a real flow? Real flow is the factor services provided by household to business plus the goods and services provided by the households, provided to households by the business. Real flow means the flow of, not the flow of money, flow of goods and services, flow of goods and services, right? And what is money flow? Money flow is the factor payments made by the business to households and the consumption expenditure flowing from the household to the business. That means what in this particular diagram, if we talk about what is the money flow and what is the real flow, when the household is providing the factor services to the business firm, this is your real flow. This is your real flow, right? And when the business firms provide the goods and services, manufacture and sells, this is your real flow. Now for the factor services, the business firms will pay the factor income. This is your money flow, right? And now the households will do the expenditure on the buying of goods and services. Again, this is your money flow. Clear? So the difference between real flow and money flow is clear. Real flow is what? The flow of goods and services, and money flow is what? The money flow is the flow of money, right? Now it says all investment is autonomous, that is not determined by the level of income or the rate of interest. Sir, here he's saying whatever he's earning, he's just spending it out, right? So there is no point of what is the level of income or what is the rate of interest. He's not going to buy anything or any money or take any money on the rent or anything, right? On loan, isn't it? So whatever he is buying as a factor income, he's spending that only, as simple as that. So he says national income is equal to net national product. National income is equal to what? National income is equal to net national product. And this is NNP. Sir, we have already studied about it, right? NNP at FC, that whatever is the factor cost at the national level, net of depreciation. So this is the circular flow of income in a two-sector economy, that how the money flows, how the goods and services flow, the real flow, money flow, everything about the two-sector economy. But if we talk about in reality, the two-sector economy in reality does not exist. It is just a hypothetical situation that he has taken, that let's assume that there is no government intervention, no taxes are there, no foreign sector is there, only what is there? The household and the business sector. A happy economy, sir. A happy economy, right? The households are providing the services, the firms are providing the factor income, households buy the goods, the firms manufacture the goods, and the households from the factor income, they buy those goods and services, the firms again manufacture the goods. So it is a kind of a closed economy, right? But does it exist in reality? No, sir, absolutely not. So now next topic is saying what is equilibrium. One second, sir, one second. So next that we are going to do is, he says what is equilibrium in the context of an economy. What is equilibrium? As a layman, forget about the economy. He says as a layman, equilibrium means the balance between two things, right? Let's say these are the two things. We say here we are keeping some brick, and here also we are keeping the brick. If the weight of the brick on both the sides is same, if the weight is same, what will be done? This handle will balance it out. So this is the equilibrium situation. This is the equilibrium situation where we say the balance between the two things, right? Now from the viewpoint of economy, what will happen? From the viewpoint of economy, from the economy point of view, equilibrium means the balance between production by firms and consumption by households. Now, what does it mean, sir? Equilibrium means that whatever the firms are manufacturing, the households are actually in need of that, and households are ready to consume that, right? If the consumption and the production if the consumption and the production matches, that is an equilibrium point, right? Let's say you want 10 chocolates, right? What is that? That is the consumption need. You want 10 chocolates, that is a consumption need. And when you go to the shop, there are exactly 10 chocolates which are there. That is what? That is the production by the firms. So what happened? That is an equilibrium position where the production and the consumption levels are same, right? So if one is up, other is up, no sir. The equilibrium is when they are at the parallel levels. An economy is said to be in the equilibrium when the production plans of the firm exactly matches the expenditure plan of the household sector. For example, ABC Limited plans to manufacture 5,000 units of product. A state of equilibrium will be reached only when there is an equal demand of 5,000 units of that product from the household sector. That is what I told you, that the firms, if the firms are manufacturing 5,000 units, there should be a demand of exactly 5,000 units from the household sector. Only then we can say there is an equilibrium in the economy, right? Only then we can say there is an equilibrium in the economy when the consumption patterns and the production plans of the firm, they coincide and they are actually in line. Okay, so that was the equilibrium in the context of an economy. Now, there is another topic, very important topic that is coming, that is aggregate demand function in the two-sector model. Now, what does it mean, sir? The first thing that we need to see, the demand. That means we are talking about from what? It can be from the household point of view, right? Basically, in the two-sector model, what is the demand? He says the aggregate demand refers to the total demand for goods and services in an economy during a given period of time. That during a particular period for which you are doing the calculations of the national income, what is the total demand for goods and services? We are not talking from the manufacturing point of view. We are not saying what is being manufactured. Now we say what is the demand for the goods and services, because if there is no demand, then how can there be a manufacturing? Right? So he says the manufacturing can only be there if there is demand for the goods and services. So why not first identify what is the total demand for goods and services in an economy, which is being defined by the aggregate demand function in a two-sector model. Now he says in a simple two-sector economy that we have already discussed about, that is where there are only household and the business sector, aggregate demand, that is denoted by AD, consists of two components. One is the aggregate demand for the consumer goods. Consumer goods is the routine usage goods, right? Consumer goods are the routine usage goods. See, as an individual, let's talk about as an individual. Let's take an example of yourself only. In routine, what can be the various types of expenditure, right? What will be your demand? What will be your demand if we talk about broadly? One thing that you can demand from your parents is a good food, right? You can demand for a Domino's pizza, you can demand for the McD burger, right? Another thing that you can demand is you can ask for the books, right? Or you can ask for some good pens, you can ask for some good fruits that you wish to eat. So all these things are what? All these things are, you are consuming it on the daily basis, right? So all these are known as consumer goods. So from the economy point of view, it is important to understand that what is the aggregate demand for the consumer goods, right? Fruits, what is the demand for fruits? What is the demand for the books? And what is the demand for the Domino's pizza, right? Or any other food? What is the demand for the McD burger, right? So it is very important because everything, when you go to the shop to buy the fruits, that person is selling the fruits to you, you are buying that, and that income that he is generating will form the part of the national income, isn't it? So everything has an importance from the national income point of view. Another thing that you can demand is a mobile phone. Another thing that you can demand is what? You can demand a mobile phone, you can demand iPhone. Another thing you can demand is a motorbike, isn't it? You say that all my friends come on the bike and I also want a good motorbike. Another thing that you can demand is a car. So all these things are what? Do you buy all these things in the routine matter? No, sir. These are known as investment goods. These are known as investment goods, right? Which are for the long term. So he says the aggregate demand has two components. Basically, one, you will be asking for the consumer goods. These are the products available for consumption by the general consumer, like you, me, in daily routine, whatever we are consuming, those are the consumer goods, right? For example, fruits, vegetables, cloth, other daily use item. The consumption expenditure accounts for the highest proportion of GDP. Obviously, sir, obviously the maximum part is what? The maximum part is the consumer goods, isn't it? Because these are the necessities which are, required by all of us in routine, isn't it? So obviously the routine things will be manufactured more in the economy, and when there is more manufacturing of these goods in the economy, they will contribute as the highest proportion of GDP, isn't it? GDP is what? GDP is the market value of the goods and services being manufactured within the domestic territory of a country. So if the country is asking more for the consumer goods, these goods will be manufactured more. Fruits, vegetables, right? The routine things, these things will be manufactured more in the economy, and obviously these things will contribute as a higher proportion of GDP. After that, he says aggregate demand for the investment goods. As I told you that you might ask for the mobile phone, motorbike and all those things. Investment goods are the goods that enable the production and are the main input in the new installed capacity. For example, machinery, equipment, land, etc. Right? So investment goods, you all understand. In a simple economy, I, that is investment goods. Investment goods is denoted by I and consumer goods are denoted by C. Now, this is a very important line. This is a very important line. He says in a simple economy, I is assumed to be constant in the short run. Why I is being, considered to be constant in the short run? Because as I told you earlier, that these investment goods, you do not buy or sell on regular basis. You do not buy or sell on regular basis. Do you buy mobile phone every day? You can say that we can survive on the mobile phone. Let's buy mobile phone every day, and let's buy vegetables once in a year or once in 5 years. Can that happen? No, sir. So in routine, what do you need is consumer goods. What about the investment goods, sir? You will buy once in a while, once in a year, once in 3 years, once in 5 years. So in the short run, this investment aggregate demand on the investment goods is going to remain constant. It is not going to change because you do not buy or sell these on regular basis. These are the one-time items. You buy a good mobile phone once, you will not need a new phone for the next 3-4 years until unless you are actually a gadget freak, isn't it? So this is what is there regarding the investment. So AD is equal to C plus I. AD is aggregate demand, C is the aggregate demand for the consumer goods, and I is the aggregate demand for the investment goods, where I is constant investment. I is a constant investment, right? Any doubts in this part? So this is the aggregate demand function in the two sector model. So what we have done so far, I'm not going to do it further, because then we have the consumption function, because consumption function when we start with, I will cover the marginal propensity to consume and marginal average propensity to consume along with the consumption function, right? Then we'll move on to the saving function. So first, what we have done today is we have discussed about a simple two-sector economy, which is absolutely a hypothetical economy. This is what? This is a hypothetical economy. Hypothetical economy means this economy does not exist in reality. So in the two-sector model, there are only two things. One is the household, another one is the business firm. Household are providing the factor services, business firm manufacture the goods and services using the factor services and they pay the factor income. Then the households, whatever the factor income they are getting, they are spending that factor income on the buying of goods and services being manufactured by the business firm. And this is the circular flow of income that continues, right? And very important small points, the factor income, whatever the income they are earning, they are not saving anything, they are spending everything. business firms, whatever the income the business firms are generating by selling those goods and services, they are not saving anything. They are spending each and everything, right? They are spending, the households are spending for buying the goods and services. The business firms are spending as the factor payments that they have to make to the household sector, right? Then we discussed about the equilibrium in the context of an economy. When will there be equilibrium? The equilibrium will be there only when the demand of goods and services will be equal to what? The demand for goods and services will be equal to the manufacturing of goods and services. That firms are manufacturing 5,000 units, the demand is also for exactly 5,000 units. That is when the equilibrium level reaches. But in reality, this equilibrium is again a hypothetical thing. The equilibrium is not possible, right? In a normal situation, in a normal economy, the equilibrium level is never there, right? Then we discussed about the aggregate demand function in the two-sector model, that what are the things that are demanded in a two-sector model where the household is there, where the business sector is there. What is the aggregate demand? Aggregate means the total demand for goods and services in an economy. So we divided the goods and services into two parts. One is the consumer goods, another one is the investment goods, right? So consumer goods are the daily routine items, investment goods are the one-time buying items. So that is why we say the investment function, the I remains constant in the short run, not in the long run. In the short run, that is within a period of say 1 year, you're not going to buy multiple mobiles in 1 year. You're not going to buy multiple cars in 1 year until unless you are absolutely freak. Isn't it? Isn't it? Which you are not, I guess. Which you are not, I guess. But some of you might be. That's totally fine, right? So in the next lecture, we are going to continue in this part only with the consumption function. What is the consumption function? We here say that the households consume the goods and services, right? They receive the factor income, and using that factor income, we are doing the expenditure. This expenditure is what? You are consuming your money, right? So we are going to study the consumption expenditure, and we are going to study the saving function also in that, right? The first thing that we will be studying in the next part is the consumption function. What is the consumption behavior of the people in a simple two-sector economy, right? This is what we are going to study, the consumption function. Very important part, because that is going to be used further also. Okay, to see you guys in the next lecture. Till then, stay safe, stay healthy, keep studying, keep sharing. Thank you so much.